Hi everyone, my name is Mary, and the pair that I like right now going forward is a short on the Euro-British pound. And there are a couple of reasons why I like this. Primarily fundamentally, I think I'm primarily a fundamental trader, and I think from a fundamental standpoint the markets are still overestimating the extent to which the ECB is going to raise rates this year. The markets are still pricing in 100 basis points of rate hikes from the ECB, and I think that's too much under the circumstances. And granted, it's not the same as it was a couple of years ago, because the Europeans have this European Financial Stability Fund, so the countries like Ireland and Portugal who need a bailout can get a bailout. But nonetheless, you've got these yields rising on the sovereign debt with some of these countries. They've even been rising for countries like Spain, and that's a real concern going forward, because if borrowing costs remain high and the ECB continues to raise rates, they're just going to get even higher and they're going to be in more of a squeeze. And also fundamentally, the ECB would probably benefit, and it would probably benefit the Europeans if the euro were a lot weaker going forward. I mean, if the euro were to continue to rally, it's going to be more difficult, since a lot of the European economy is based on exports and tourism. But the pound is fundamentally in a much better shape than the euro. The pound's sovereign debt is in no risk of being downgraded according to the rating agencies, although some people don't believe the rating agencies anymore these days. But since the pound doesn't have to contribute to any funds to bail out any weaker countries, they're really a much more stable currency right now. So I think that you're buying the pound, and despite the fact that there were slightly dovish minutes from the Byoa, the pound still retained most of its strength today. So fundamentally, I think very few people would argue that the pound is in better shape than the euro right now. And you've also got looking at the charts, technically, you've got what looks like a really nice head and shoulders here. Now, head and shoulders form quite a bit on charts. They don't always break out, but it does show that this 89 level, 89.28, is going to be a very tough level for this pair to cross. You'd have to have a real momentum in the euro going forward to cross this. And I think if you shorted and put a stop above 89.50, that would probably be a reasonably prudent stop. And you've also got a bearish cross here in the MACD, and you've got some other technicals that I like here. You're showing divergence going down. You're showing a cross with these two ARSIs, which I like. And even though it is still technically in an upward trend, you do start to see changes in the relative strength index of this particular pair. So the other reason that I do like this is it's going to be a little bit more difficult to trade the US dollar pairs over the next week, because there's a holiday in the US on Friday and most other countries, and then you've got the Fed meeting going forward next week. So the market's going to be looking at the US dollar pairs. A lot of the big institutions may just wait and see what the Fed says before they decide to take any big trades, so there might be less liquidity and it might be more difficult. But one thing that's interesting about the Euro-British pound is it is a little bit correlated to the risk appetite trade, because, and not as much as some of the other pairs like the dollar or the yen, but you can see that it does tend to go up when the stock markets rally. And on a day like today, you can see that we did have a nice move upward in this particular pair when we had the futures spike up, and that may have also been due to the better than expected Spanish bond auction. But the euro also tends to go up a little bit more than the pound when the markets rally, and that's interesting to note. For instance, the euro did go up 150 pips today, and the pound didn't go up quite as much as the euro. So that's an interesting correlation, and it means that the euro is a little bit more sensitive to the risk appetites of the market. But anyway, I do like this one going forward from the short side, and I think that the euro has more downside potential against other currencies, but it's hard to short the euro against the commodity currencies these days, because you're really playing with fire when you trade the commodity currencies, since they're all so grossly overstretched to the upside. The Australian dollar and Canadian dollar, New Zealand dollar, they've all been on an incredible tear. And, you know, one of these days there's going to be a big pullback, so you don't want to be the one that's caught in the pullback.